Good morning. This is Japanese Economic Review Channel. Welcome to today's briefing. On March 25, 2026, the Nikkei 225 witnessed a historic surge, closing up 1,497 points, or 2.86%. This explosive movement was fueled by overnight signals of de-escalation in the Middle East, which triggered a massive unwinding of short positions by institutional capital. The rally was broad-based and decisive, successfully breaching the psychological 54,000 intraday barrier and signaling a major shift in market sentiment. The primary catalyst for this rally was a pivot in geopolitical signals. Reports emerged that the U.S. submitted a peace plan to Iran, while Iran signaled to the IMO that non-hostile vessels would be permitted passage through the Strait of Hormuz. Although WTI crude initially spiked due to conflicting reports and immediate friction, broader market sentiment looked past the volatility, aggressively pricing in a sustained de-escalation trajectory. In contrast to the rally in Tokyo, U.S. markets retreated on March 24th, with the NY Dow falling 84 points and the Nasdaq dropping 184 points. Geopolitical opacity and oil price spikes weighed heavily on broad indices. However, the semiconductor sector remained a notable exception. Leaders like Applied Materials and Texas Instruments showcased stark relative strength, climbing higher on structural demand for AI and networking infrastructure. The intraday rebound in Japan was exceptionally powerful. The Nikkei reached an intraday high of 54,022 by 9:39 a.m. Market breadth was overwhelming, with over 90% of the prime market, 1,461 stocks, advancing. This surge was backed by significant liquidity, with 7.04 trillion yen in turnover and 2.19 billion shares traded. This volume confirms that institutional investors have moved decisively from the sidelines back into the market. Sector analysis reveals an aggressive risk-on posture among investors. Of the 33 topic sectors, 32 advanced, led by financials like Tokyo Marine and MUFG, and tech machinery like Disco. Crucially, mining was the sole declining sector. This outlier status indicates that equity markets are forecasting sustained energy supply stabilization, effectively discounting the brief commodity friction seen earlier in the week. The Growth 250 index also advanced, with capital flowing into high-growth mainstays like QPS Holdings and Synspective. However, we observed high selectivity in the IPO market, where 2 new listings broke below their offering prices, proving that investors remain cautious regarding untested equity. Meanwhile, the USD JPY remained stable near 159, providing a friction-free backdrop that supported broad-based domestic buying. Recent corporate activities reflect 3 strategic pillars. First, global capital allocation, seen in Toyota's $1 billion U.S. investment and Tokyo Marine's partnership with Berkshire Hathaway. Second, product innovation, such as Fujikura's next-gen fiber optics and Meiji's cacao denim. Finally, domestic infrastructure, with initiatives from Osaka Gas and Meitetsu. These moves signal a focus on long-term resilience beyond market volatility. To synthesize, we see 3 key trends. The geopolitical premium is deflating as markets look past short-term commodity friction. Second, structural tech demand remains bulletproof, impervious to macro shocks as evidenced by the strength in semiconductor stocks. Finally, mega-cap capital deployment is accelerating, signaling long-term confidence. These factors combined suggest that the market is now positioning for a period of strategic growth and renewed stability. Thank you for watching the Japanese Economic Review. We look forward to having you with us again.